Good day everyone! For Plantation Division Question A, I will explain the distinction between bearer plants and biological assets in a palm oil plantation, including their classification, measurement, and importance for faithful representation. As shown in the table, all palm trees are classified as bearer plants under MFRS 116. They are plants used to produce agricultural produce over more than one accounting period and are not intended for sale. Therefore, they are measured at cost less accumulated depreciation and impairment. In contrast, fresh fruit bunches or FFB are classified as biological assets under MFRS 141. They undergo biological transformation as they grow and develop before harvest. As a result, they are measured at fair value less cost to sell. This distinction is important because different classifications reflect the economic substance of the assets. Oil palm trees function as long-term productive assets, while FFB are the agricultural produce generated for sale. Since the value of FFB changes as they grow, measuring them at fair value provides more relevant information. Therefore, proper classification provides a more faithful representation of the company's financial position and enhances the reliability and relevance of financial reporting. Thank you.
Question B. For Part A, the CFO valuation compromises two qualitative characteristics of faithfulness representation, namely naturality and free from error. The valuation lacked naturality because of the CFO want to report higher asset and profit to attract investor. It also lacked freedom from error because it ignored biological transformation risks and uncertainties. For Part B, although the CFO treats immature FFB as a biological asset measured at fair value, the economic substance is that they cannot yet be harvested or sold and still face biological risk. For Part C, a more faithful valuation approach should consider the maturity stage of the FFB biological risk and use a risk-adjusted fair value. Therefore, the CFO valuation does not achieve faithful representation under the IASB conceptual framework.
For the question 1C, I will be discussing the ethical risk faced by the junior accountant, the action that should be taken before and after, and the responsibility owed to external user. First, there are several ethical risks in this case. When the CFO instructed the finance team to value immature FFB using the market price of harvested FFB, they recognized a 6.5 million fair value gain. This may affect integrity because the financial statement could be misleading. Other than that, it also creates a threat to objectivity as the CFO is under pressure to present a stronger financial result to a potential investor. In addition, accountants are also expected to exercise professional competence and due care by ensuring compliance with MFRS 141. Next, before we raise concern, the junior accountant should review the requirements of MFRS 141, gather supporting evidence, and document the issue. The concern should then be discussed professionally with the CFO. If the issue is still not resolved, it should be escalated to senior management or the audit committee while keeping proper documentation of all communication. And lastly, accountants have responsibility beyond their employer, so they must protect their public interest by ensuring that financial statements are accurate, reliable, and not misleading. This is important because investors, creditors, and other stakeholders rely on this financial statement, especially when making decisions.
Moving on to real estate and property division part, we need to determine the correct accounting classification for each property. First one, property 1, which is the corporate and retail tower, should not be classified entirely as investment property. This is because the 7 floors rented to external are classified as investment property under MFRS 140 because they generate rental income. However, the remaining 3 floors are used as the company's headquarters and administrative office. So, they are classified as PPE, Property, Plant and Equipment, under MFRS 116. Since this flow can be legally separated, they should accounted for separately. Next, property 2. The horizon land plot should be classified as investment property under MFRS 140. This is because management has not yet decided to develop the land and it is currently being held for potential capital appreciation. Lastly, property 3, the Zenith condominium, should be classified as inventory under MFRS 102 because the company intends to sell the condominiums in the ordinary course of business upon completion.
For question B, the measurement of each property depends on its classification in question A. Property 1 is a mixed-up property, so it must be split into two portions. The 7 lease floor are investment property under MFRS 140. Measure initially at cost and subsequently using the cost model or fair value model. While the 3 office floor are PPE under MFRS 116, measure initially at cost and subsequently using the cost model or revaluation model. Property 2 is investment property, so it is measured at cost initially and then under the cost or fair value model. Property 3 is inventory because it is developed for sale. So it is measured initially at cost and subsequently at the lowable of cost and net realizable value. The CFO proposal violates faithful representation because it ignores the actual use and economic substance of the property, which may mislead user about the company financial performance and position.
For question A1, product recall cost, fresh test must recognize a provision. The public announcement create a constructive obligation from selling the continuated juice. Since a 70% return rate is probable, we record the single most likely amount of 1 billion ringgit of the balance sheet. For question A2 Roman, consumer lawsuit, we do not recognize it as provision. Our legal advisor state there is only a 30% chance of losing, which falls below the required 50% probability threshold. Instead, we will disclose this as a contingent liability in the footnotes, estimating an impact between 2 million and 3 million ringgit. And last one for question B, how uncertainty affect recognition. Uncertainty acts as the gatekeeper under MFRS 137. It enforces a strict 50% threshold to decide if a risk goes on the balance sheet or in the footnotes. For single outcome, uncertainty is resolved by picking the most likely amount. Ultimately, it ensures risk below 50% and are still transparently disclosure rather than ignored completely.